So, welcome back, dear students, for the day two of this marathon, Elance marathon question practice. As scheduled before, we'll be discussing risk management today, and we'll be focusing from your students' comment. I could feel that the theoretical part is a bit more confusing, so I'll be taking more time to discuss the theoretical questions. So make sure that all of you have this file, which is I shared in our Elance Marathon question practice group. Plus, please do open this exam kit, Kaplan exam kit. This is what I'm using. If you doesn't know this, if you doesn't have this, no worry. Just look at my screen. Or else, if you have this, please do take this Kaplan exam kit. Okay. Yeah. So let's start. See, there are two chapters. There are two chapters in our risk management module, which are one is forex risk and other one is interest risk. See, if you are open the file in Wood in this manner, you will be having the opportunity to type in the file itself. If you click this text, you can type here. So there are two types of risk. One is forex risk. I will make a little more size bigger. So forex risk, and second risk is interest risk. These are the two risk we are considering in this module, risk management module. So we are starting with forex risk. Using the forex risk itself, we could clear the theoretical questions, majority of the theoretical question. So foreign exchange risk is regarding the forex rates, change in forex rates. Think about the ACC exam fees. The invoice of ACC exam fees, is it invoicing in our local currency or is it invoicing in pounds? Could you please comment? Is it invoices happening in our local currency or invoices ACC exam fees, our subscription fees? Is it in our local currency or foreign currency pound? It's in foreign currency pound, right? So this chapter, forex risk chapters or forex risk is only, we are only exposed to forex risk if the invoices are in other than local currency. Invoices are in other local currency. Assume everyone are in India and we are Indian company. Assume everyone in India and we are Indian company. Then our local currency will be Indian rupee. We sold goods to Sri Lanka or we sold goods to US. We sold goods to UAE. Is it going to be a foreign transaction or not? What's your opinion? We sold goods to Sri Lanka. We sold goods to UAE. We bought goods from UAE or Sri Lanka. Is it going to be an forex risk? Not always. Do remember this, not always. We sold goods to Sri Lanka if the invoice is in Indian rupee. If we bought goods from UAE and again invoiced in Indian rupee, the amount what we are going to pay in Indian rupee or the amount what we are going to receive in Indian rupee is certain, since the invoices are in our home currency. So do learn this. Not every important export won't be having forex risk. Forex risk will only comes with if invoices are in home currency or other than home currency. Forex risk is open if the invoices are in home currency or other than home currency. What's your answer? Other than home currency. If it is in our home currency, assume your ACC fees is always invoices. Assume your ACC fees is 12,500 Indian rupee. Assume. Or did I kept for recording? Let me check. Yeah, it does. See, assume if at all our ACC exam fees were Indian rupee 12,500. Whatever the exchange rate might go up 95, 98, 92, whatever it is fixed in 12,500 rupee. This will be certain if at all the invoices were in Indian rupee. But unfortunately, our ACC exam fees are not in Indian rupee. It is invoiced in pounds, that is not our currency, so that we are open for forex risk in our ACC exam fees transaction. Did you got that? Please do confirm yes or no. If we invoice in home currency, no forex risk. If we invoice in other than home currency, then the risk is open. Could you please confirm yes or no? Yes? Good, good. There are three types of forex risk. There are three types of forex risk. There are three types of forex risk. One is transaction risk. Transaction risk. This is about only one transaction. We have an import which is invoiced in foreign currency, or we have an export which is invoiced in a home currency. The payment or the underlying transaction happening today, and the payment or receipt of that underlying transaction is going to be happening in a future date. So the forex rate between underlying transaction and the settlement of that payment or receipt is going to be happen in a different date. So the exchange rate changes on these dates. That makes our payment or receipt uncertain. That uncertainty is our risk. Assume, see here is an example for transaction risk. See, we one second. Yeah. On 1st January, it's not working. Let me take my pen. On 1st January, we decided to buy. Buy means it's importing, right? Importing equipment from, we are a UK firm. Since we are a UK firm, our home currency will be pounds. We are buying an equipment and invoices are in dollars. So it's open for forex risk. The invoices, is it going to be settled on the same date? No, no, it is going to happen on 31st March. So the forex rate between the underlying transaction date and the settlement date will change. Due to this, whether we know on 1st January itself, is it certain what will be our payment in pounds? What will be our payment in pounds? Is it certain today on 1st January itself? What's your answer? What's your answer? On today, 1st January itself, does it certain what is our payment is going to happen in pounds? No, right? It is certain that the payment will be $300,000. Assume, I think you doesn't get it. Assume today is 1st January. We bought an item and we have to pay $300,000. Not today. The payment is going to happen on future 31st March. On 1st January itself, is it certain what will be our payment in pounds? Is it certain or not? Say yes or no. Is it certain or not? It's not certain, right? So our payment might increase or decrease. One transaction's payment might increase or decrease due to the forex rate change on 31st March. That uncertainty creates a problem. That is the transaction risk. Is it okay? Transaction risk is the change of exchange rate between an underlying transaction date and its subsequent settlement date. That uncertainty what we are facing on our future payment or receipt, that is said to be a transaction risk. Is it okay? Please do respond. Please do respond. If you have any doubts, you could unmute and ask, okay? Yeah, good. So there are other two risks. Second one is economic risk. Third one is translation risk. Translation risk is easy to explain. Translation risk is easy to explain. Translation risk is just an accounting risk. Translation risk is an accounting risk. This is not a real risk, not cash flow risk. See, normally these companies works under a group structure. Assume this is a parent company, subsidiary company 1, subsidiary company 2. Parent company is in dollars, subsidiary 1 is also in dollars, but subsidiary 2 is in euro. On consolidated FS, the figures will be parent plus subsidiary 2. These two could be clubbed very easily. Why? Parent plus subsidiary one could be easily added. Why? Since they are in same currency. But every year, while we preparing this FS, every year, while we preparing the financial statements, we need to translate this euros into dollars in order to get consolidated. Due to that, due to the foreign exchange rate changes in every year, previous year, current year, the exchange rate might not be the same. Due to the changes in forex rate, the value of the assets and liabilities in consolidated FS, the value of assets and liabilities in consolidated FS might increase or decrease. Due to this, there will be a gain or loss in the accounting books. That is said to be translation risk. Is it okay? Is it okay? Could you please quickly say yes or no? Based on that, we could continue to other topics. There are n number of good topics that requires Mohammed Asif. What's your doubt? Could you please unmute and ask? See, while we consolidating the figures of a subsidiary which is in foreign currency, we have to translate in dollars. While we translating every year's assets and liabilities amount, the figures might increase or decrease. The value of asset increases, it's a gain. The value of assets decreases, it's a loss. This is a gain or loss due to changes in foreign exchange between 2 years. This is not an actual loss, it's an accounting books loss only. Is it okay? Asif? Yeah, could you everyone please pay attention quickly? This is not a regular class. I can't we won't be able to come to the same topic 3 or 4 times. In our regular session, definitely we'll be discussing 4, 5, n number of times, but this is a question practice session. Without quickly discussing this, I'm damn sure that we won't be able to effectively practice the question. So having said this, I'm continuing to the economic risk. See, economic risk, I'll make a simple example. We are an Indian company. We are an Indian company. We are selling goods to Sri Lanka. Assume we are selling goods to Sri Lanka. So Sri Lankan customers has to buy Indian rupee in order to make payment to us. Is it okay? I'll come once again. Please listen carefully. We are selling goods to Sri Lanka. So Sri Lankan peoples are buying goods. Sri Lankans goods are buying goods. In order to pay towards us, they require Indian rupee. They require Indian rupee. Similarly, Chinese companies also selling goods to Sri Lanka. Assume Chinese companies also selling goods to Sri Lanka. So few customers are buying from Indian company, few customers are buying from Chinese company. The Sri Lankan customers, listen carefully, the Sri Lankan customers which buys from Chinese company, they require Chinese currency to make payment. For the Sri Lankan customer who is buying from Indian company, they require for making payment Indian rupee. Is it okay? Please confirm. Please confirm. There are 2 type of customers in Sri Lanka. One is buying from China. One is buying from India. For making payments for Chinese companies, they require Chinese currency. Those who are buying from Indian company, they require Indian rupee. And we are Indian company. We are that Indian company. Assume the value of Indian currency increases. Assume value of Indian company increases. Value of Indian currency, not Indian company, my mistake. Indian currency increases. What happened? The Sri Lankan customers, those who are buying from Indian company, has to buy costlier. Now the Indian rupee is increased. The value of the Indian rupee increased. So in order to make payment, they have to buy costlier, value increased Indian rupee. That makes their purchase costlier or cheaper. The value of the Indian currency is increased. So they have to pay more Sri Lankan money to get the Indian rupee. That makes their purchase costlier or cheaper. That makes costlier, right? Most of the case, many of the Sri Lankan customers will turn from buying from Indian company to which company? Indian company to which company? Chinese company. So poor Indian company, poor Indian company. We lost one sale or many future sales. Is it about only one sale or many future sales? We will lose many future sales, right? If for example one transaction, it was transaction risk. Due to the increase in home currencies value, the Sri Lankan customers now find it difficult to costlier to purchase the Indian rupee. They will turn out to Chinese currency. I will change the same example in other way. Assume there is no change in our currency, Indian currency. Assume there is no change in Indian currency. The Chinese currency now became cheaper. Chinese currency now became cheaper. This will also affect in the same manner. Not our currency, our international competitor was Chinese company. Indian company's international competitor was Chinese company. Chinese currency's value depreciated, value decreased. Now it is more cheaper for Sri Lankan customer. Now it is more cheaper to Sri Lankan customers to buy from Chinese company. Similarly, as I said previously, the Indian companies will lose many sales. Right? Right? Is it okay? Is it okay? This is said to be economic risk. This is said to be economic risk. Okay. So there are three types of risk. There are three types of risk. Transaction risk, which is about only a single transaction. Next one is economic risk. This is more longer term risk. Another one is translation risk. This is not an actual cash flow risk. So we are not studying hedge of this. What does it mean by hedge? See, due to the fluctuation in forex rate, are we facing any uncertainty in our payment and receipt? Due to fluctuations in forex rate, are we facing any uncertainty in forex rate? Yes, it is, right? So we are trying to reduce that uncertainty. Using some methodology. That process is said to be hedging. Hedging means we are reducing the uncertainty. For translation risk, since it's not an actual cash flow risk, we are not learning to hedge that. We are ignoring. We are not hedging. How to hedge the economic risk? See, in my example, which country's company was gaining advantage? It was Indian companies or Chinese companies? From my example, which companies were gaining advantage? It was Indian companies or Chinese companies? Chinese companies was getting gains, right? Getting gains. So assume our Indian company, the same Indian company had operations in Chinese also. We had a subsidiary in China also. What happens out of the total group? The same company has operations in India, plus the same group has operations in Chinese. What happens inside the group? We will lose some sales for the Indian company. We will gain more sales through our Chinese subsidiary. So overall, it will be balanced. We will lose some sales in Indian subsidiary or Indian company, but the same group companies from the Chinese country will gain, so that we will offset. So how to mitigate this economic risk? Diversify all business aspects. To one economy or into different economies? What's your answer? Diversify all business aspects to only one economy or into different economies, different country economies, so that we are not prone to the changes risk of a single economy. Now we will learn about how to mitigate transaction risk. See, this is the core risk we will be considering more. There are two methods to reduce the transaction risk. One is internal method. Other one is external method. Internal means internally we will do some methodologies, some processes to make uncertainty. External means we will enter in some contracts. We will enter in some contracts. Enter in some contract to reduce the risk, to make certainty. See, external hedging, there are two types of contracts available. One is over the counter contracts, other one is exchange traded contracts. I'm going to focus on this part. This is the confusing area. External hedging is the most confusing area. So in between, there are a lot of good easy marks topic. I'm not considering that. I know most of you guys are struggling in this derivative part, futures, options and all. Am I right? External hedging. Since our time is very less, I'm not going to discuss the entire internal. Yes? Yeah. So external hedging, if you come to the slides, see there are a lot of other example explanation for this. Bid price, offer price, internal method. This hedging forex risk means hedging transaction, forex transaction risk. Transaction risk. But these are the internal methods. I'm not discussing this now. Invoice in home currency, leading or lagging, matching, netting, use foreign bank loans, or do nothing. So external hedging methods. Please do take this. Please do take this. And if you open the file in Microsoft Edge, Microsoft Edge, not Hedge, it's Edge. You have the opportunity to type here. Okay. See, as I said, there are two. External hedging means we are entering in a contract to make certainty. To make certainty. Okay, assume. I'm just making a simple example, cricket example. Most of the tutors use this example. Assume we already had we had already an agreement or a contract with one of our friend. There's a match going to happen between India and Pakistan. Cricket match. Everyone is looking for that Asia Cup, which is going to happen in a few days. So India versus Pakistan, we already been into a betting with one of our friend, non-monetary betting, okay, which is legal here. Monetary betting is not legal here. Okay, so we made an agreement with the friend that we said India will win. India will win. Is it 100% certain India always wins against Pakistan in the cricket? Is it certain? Was it certain? No, right? So after entering the contract, after entering this agreement, we thought that, oh my God, I made a big mistake. There's a chance India might lose. So in order to get protected from this risk or make certainty, we could enter into an other contract. We could, in order to make certain this, we could enter into another contract which says India will win. No, we will enter into a contract which says with our other friend, we will enter into a contract which says Pakistan will win. If India win, we will gain here, then we will lose at this side. It makes certain both of the things will get cancelled off. If India loses, we will lose here, but we will win here, so that it will get closed. So that means externally, if we are making some contracts for the underlying item, underlying contract or underlying transaction, if we enter in a separate contract, we could make certainty. So external hedging, that means we are entering into a separate contract. We are entering into a separate contract. There are two main areas we could enter contract. One is, see, as I said earlier, you have the opportunity to type here. Please do type here. There are two areas you could enter. One is over the counter. Over the counter. In short, we will say it is OTC. In short, we will say OTC. These are the contracts which is made from bank and financial institutions. Financial institutions. institutions, financial institutions. The second contract you could enter from a stock exchange traded derivatives, exchange traded, that's it, exchange traded contracts. In short, we will say it as ETC, exchange traded contracts, ETC. Okay, so there are two contracts. Exchange traded means these are from stock exchange. These are from stock exchange. Yeah. So see, not regarding this risk management. Assume you are a company, you are a part of a company. Assume you are a part of a company. You need to raise finance. Either you could approach a bank, a financial institution, or from capital markets like stock markets, you could raise the fund. There are two markets you could raise the fund. One is through bank and other one is through stock exchanges. If you are raising fund through banks, that is said to be over the counter financing. If you are going through a stock exchange, it is said to be exchange traded financing. So any contracts done through financial institutions like banks is said to be over the counter exchange traded. If at all it's through stock markets, it is said to be exchange traded. Now, please write here. You need to by heart this, okay? Forward contracts are over the counter contracts, OTC. Money market hedging is also with bank. It is also OTC. In derivatives, currency futures are exchange traded contracts. Options, this could be over the counter options or exchange traded options also available. Options can be available from the bank or it can be available from the exchange. Currency swaps, they are available from over the counter. Please note it down. I'll wait. Once you've done this, please let me know done. Using these, we are going to solve a good number of questions. Using this and next slide, we are going to solve a good number of questions. Once you noted this, please do comment done. Knowing which contract is from which institution is core base to answer the theoretical parts. Now, this forward exchange contract means, see, assume we have a fees payment. Assume we are decided to write December exams, not for FM. We are going to pass this FM exam for this September session itself. That's why we are here, right? So we decided to write another paper like the advanced paper, SBR or whichever it is. Okay, we already decided to write it in December session. We know that we have to make a fees in the future. On the day of payment to pounds, what will be the forex rate? Is it certain or uncertain? Quickly say. On the day of that future fees payment, what will be the forex rate? Is it certain or uncertain today? It is uncertain, right? So we will go to the counter of the bank. Hey banker, let's make an agreement. I will come after some days. We will precisely say the date. On for December exams, we'll be paying the fees on, assume it is on November 10th. We are making payment on November 10th. So we will say to the bank, hey banker, I will come to you on November 10th and I need, I don't know the exact fee, assume it is 130 pounds. So we'll say, I will buy 130 pounds. We will enter in a contract today itself to buy 130 pounds. So we are fixing in forward contracts, in forward exchange. This exchange doesn't mean exchange traded. That's a foreign exchange terminology. It's from over the counter. See, we went to the bank and we fixed date. We said we will be coming to you on 10th of November. and we fixed currency in order to make fees payment. Which currency you require? Pound, dollar, which one you require? Please quickly. Pound, GBP, pound sterling. And we fixed volume of currency. How much GBP? 130. And we fixed position. We require GBP, right? So we are ready to buy GBP or we are ready to sell GBP in order to make payment. For making payment, I will keep a little slow here. Please listen carefully. For making payment, if you put in your pockets, you will get Indian rupee, right? If you put your hands in your pockets, you will get Indian rupee. You will go to the bank with this Indian rupee. You are ready to sell the Indian rupee in order to buy pounds, right? So to make payments in pound, you will buy GBP. You will enter into a contract to buy position. Is it okay? Array, it's a payment. It's a payment. In order to make pound payment, you need to buy pounds. Is it okay? Is it okay? Yeah. And we are fixing one more thing, the forward rate. The forward rate. The rate, assume it is 95, not dollar, my mistake. 98 rupee per GBP. This is not today's rate. This is the rate what we fix. So all these things are we fixing with the forward contract. On 10th November, see on 10th November, the real forex rate, it might be 100 rupee per GBP or it might be rupee 90 per GBP. Whatever the rate, we are already locked at these conditions. So forward contract is making certainty. Forward contract is making certainty today itself. What was our risk? What was our risk? It was uncertainty, right? So if you enter into a contract to fix everything, what all things we are fixing? Not only the rate. Most of the students will learn the rate are fixed. The rate are fixed. Not only the rate, date, currency, volume of currency, whether it is GBP, whether we are going to buy or sell, that position of currency, plus the rate is fixed. So today itself, now after entering into a forward contract, the payment or receipt of that underlying transaction is certain or uncertain. Is it certain or uncertain? Please do respond. Please do respond. It is certain. It is certain. Okay. Okay. See, this over the counter forward makes everything in locked. Everything locked. So please note here. Please note here in this slide, forward contracts makes everything locked. We are locked. Similarly, the same fixed locking we will get in futures also. Futures. Array, since we are learning forex rate, I made this terminology, currency future, currency option, currency swap. This is for since it is a forex chapter. If you know it was an interest chapter, I'll write interest future, interest option, interest swap. So you can ignore this future, option, swaps. So my mistake, I written as futures again. This futures makes the result lock as same as forward. So we have two lock-in methodologies. Our whatever the exchange rate might increase or decrease. The final answer will be locked in a position. That lock could be attained from over the counter and from exchange rate. If you are taking the lock from over the counter, that is said to, that contract is said, named to be forward contract. If you're taking the lock-in rate, if you are taking that lock-in rate from exchange traded, it is said to be what? It is said to be what? If you're taking the lock-in rate from exchange, that locked contract is said to be what? You have to learn this name. Why? Because based on these names, we have to state whether it is a true or false. You can take, hello, listen. You can take contracts from two area, over the counter and exchange traded. If you are taking a locked position from over the counter, it is said to be forward contract. The locked rate from over the contract is said to be forward. Similarly, the same answer could be attained from exchange. That contract is said to be what? Could you please comment? Those who got the idea, could you please confirm? Could you please comment? Excellent. It is futures. It is futures. We will be in a locked position if we take forward or futures. But do remember, forwards are from over the counter and futures are from exchange. Futures are from exchange. Now, having said this, I'll make an example. I'll make an example. See, we have to wait for a few more 20 to 30 minutes in order to discuss this knowledge part. After discussing knowledge, we will be easily able to look at the answers. I mean, practice the questions. Is this a lecture or actually a practice session? It is actually objective was to practice question, but I know most of you guys are not good at this theoretical part. That's why I'm in first 1 hour I'm delivering the lectures. Okay, excellent. So let's continue. See, assume we decided today, okay, today we decided to buy we decided to buy an apartment. Okay, after 5 months. Today we went to a builder. And we made an contract. We entered in a contract. Today itself we entered in a contract. Entered in apartment future or forward. You can say future or forward. Both makes our results what? In a what position? Both, whether it is a future or forward, both makes our in a what position? Please do comment. In a locked position, right? So we entered in an apartment future or forward contract to buy. The position is to buy the apartment. To buy the apartment at 75 lakh. 75 lakh. We are ready to buy at 75 lakh. Okay. Please do listen carefully. Today we decided to buy an apartment, and today itself we entered into an contract. It can be a forward or future contract to buy the apartment at what price? 75 lakh. After 5 months, Mubashir, please don't write in the screen. After 5 months, assume the market price of apartment. Jisni, please don't write. Assume the market price increased to 80 lakh. We'll be so happy. Why? We already took an lock-in rate. We could buy the 80 lakh worth property at what price? Since we already locked the rate. At what price? Please respond. Please respond. We could buy the apartment at 75. We'll be happy. The final answer will be, the final payment will be, once again, yeah, we'll end up paying 75 only. Final answer will be 75. Assume what if market price reduced to 60 lakh? Oh my God. At this point, we'll be happy or sad? We'll be happy or sad? Sad. Why should I log this? Right? See, we are not here to whether price increase or decrease, what we are trying today, we are trying to make it certain. I don't want more gain or I don't want to lose any money. I need to make it certain. That's our objective of risk management. The objective of risk management is not to gain more or less. So if you take future or forward, whatever the market price, you are locked in a position. Hope this is okay. Now, assume the increase in market price, this was an adverse movement, this was a favorable movement in the market, right? See, you are planned to buy an apartment. You are planned to buy an apartment. The market price of item that you plan to buy increases. You will be in tension. Oh my God, the price is increasing. If you are not taken the future, okay, assuming you are not taken that future forward, assume you are open for risk. The item's price increases in the market. The item's prices increases in the market. You will be, oh my God, I didn't take any risk management. The price is increasing. Oh my God, I have to pay more. This is an adverse movement for the. This is an adverse movement for the potential buyer. Since we took a forward, we are protected from the adverse movement. Yes or no? Since we already taken forward that lock-in rate, we are protected from the adverse movement. Okay. Now again, assume we doesn't took future or forward. Assume we doesn't entered in future or forward. We are open for that risk. We are open for the risk. Okay. Now the market price of the item that you are planned to buy is decreasing. The item that you have decided to buy, the price of the items that you decide to buy is decreasing. Is it a favorable movement in the market or adverse movement in the market? It's a favorable movement, right? It's a favorable movement. But since you already entered in the forward, you will lose the opportunity. You will lose the opportunity to take the advantageous movement in the market. Am I right? You won't be able to take the advantages in the market. Am I right? Okay. Great. Either way, you have to fulfill the contract at what price? Whether it's an adverse movement in the market or whether it's a favorable movement in the market, you have to fulfill the contract. You have to fulfill. It's a binding contract. You have to fulfill the contract at what price? 75. Okay. So if you come down, there's in page number which page number? In page number 18, PDF page number 18, you can say there's an advantages and disadvantages of forward. Using this is the last slide we are going to discuss before question practice. After discussing all these points, definitely we'll be able to solve a good number of theoretical questions. Are you ready for this? Learning 6 points, we are super good to practice theoretical question. Okay. See, these are the advantages and disadvantages of which contract? These are the advantages and disadvantages of which contract? Forward contract, right? Which is the mother organization of this forward, whether it is over the counter or exchange traded. Forwards are over the counter or exchange traded. They are over the counter, right? Over the counter. Yeah. So, see, no opportunity to benefit from favorable movement in exchange rate. If there is an favorable movement in the market rate, do we have any opportunity to take that advantage? Say yes or no. Say yes or no. No, right? So it's an advantage or disadvantage of forward. It's an advantage or disadvantage of forward. It's a disadvantage. Similarly, Similarly, which one is also lock-in rate? Which one is also lock-in rate? Not only forward, but also which is also lock-in rate? Futures also. So this disadvantage is same for futures. So you can type here in this file. Please do type same as which contract? Same as which contract? Future. Same as future. Same as future. Same as future. Future contracts. Is it okay? Is it okay? Yeah. Now, one contract. See, one contract, we will be protected from adverse movement. We will be protected from adverse movement. Plus, you have the opportunity to take the favorable movement in the market. That contract is said to be options. That contract is said to be options. In case of options, please do listen. I'm going to explain what are options contracts. In options, we are not locking the rate. We are not locking it. We have a flexibility. See, in options, the 75 means if we have decided to buy, we can buy at 75. No need of compulsory fulfill the contract. Okay. See, looking at this price for options, this price is said to be exercise price. The 75 lakh, it's not a locked rate. It's said to be exercise price. Exercise price. This rate, this 75 is said to be exercise price. That means if you are fulfilling the contract, you can buy at 75. Is it a compulsory? No, you have the option. So options are right, but not an obligation. Options are right, but not an obligation. Obligation. We have a right to buy at 75, but there is no obligation to buy at 75. Is it okay? Is it okay? Please respond. Options are right, but not obligation. We have a right to buy at 75, but we don't have an obligation to buy at 75. If market price, see, if market price is increased to 80, it's an adverse movement. What you will do? You will buy at the higher price, or you will buy at the exercise price. You will go for the market price, or you will go for the 75. Which is better for you? It is 75, right? So you will fulfill the contract. That means it is said to be exercise option. So you will end up paying with how much only? 75. Okay. The terminology exercise means you are fulfilling the options contract. Options, see, option exercise means you are fulfilling the option contract. That means you are buying at 75. Now, what if market price reduced to 60? What if market price reduced to 60? Buying at exercise price 675 or buying at 60, which is better now? Which is better now? Buying at 75 or 60? Are we locked in option? No, we are not locked. We have a right, but not obligation. So what we will do, we will lapse, do learn the terminology. We will lapse option contract and we will buy from market. We will buy from market at market small rate of what? 60. So we will lapse the option. We will lapse the option and buy from market at what rate? 60 lakhs. Is it okay? Please respond. The terminology exercise and lapse. Exercise means we will fulfill the option contract at exercise price. If we lapse the option, that means we are not taking at exercise price, we'll go for the market price. So for the options, are we losing this disadvantage? Is this it? Are we losing the opportunity of favorable movement in the market? Are we losing? Say yes or no. Are we losing the opportunity of favorable movement in the market? No. So options contracts, please type here. Please type here. Please do type here. Only options contracts. Only option contracts provides with the opportunity to take benefits of favorable movement. Only options contracts provides with the opportunity to take benefits of favorable movement. Arey, is this a practice session or normal lecture? No worries, we'll practice. Shall we continue quickly? I'm aggressively waiting to practice a few questions. Yeah, great. So, but see, do you think the other party who gave us this right, it is said to be counterparty, okay? The other counterparty, who provided with this who provided with this flexibility towards us, they are not going to give free of cost this. In options, since we are getting a flexibility, in option contracts, we have to make a payment for flexibility. We need to pay for option. So that is said to the cost of the option said to be premium. We have to pay a premium at the start itself. We need to pay a premium at the start. In future, whether we exercise or not, we have to make this payment premium. In future, whether we exercise or lapse, whether we fulfill the contract or we just lapse it, that's not a concern. The counterparty is giving a flexibility to exercise or lapse, so you have to make the premium payment at what point itself? At the time of contract is made, or at the time of contracts are exercised or lapse? At which point we have to make the premium? Only at the time of exercise or only at the time of lapse? No, initial times. In future, we might exercise or lapse, but initially itself we have to make payment premium. So options are costlier. Options are costlier. Now, if I come to this, from which all institutions we could get options? There can be over-the-counter options and exchange traded options. Examiner might say like this. One second. Oh. Might say like this. Options on forward. That means we are not taken a lock-in rate. By paying a premium, we took an exercise price. These options are options on forwards. Forward is an over-the-counter option. So if at all examiner said options on forward, that means this is an option we took from exchange traded or over-the-counter. Could you please comment? These are over-the-counter options. Okay, excellent. And examiner could ask options on futures. That means they are exchange traded options. Okay. Now, see, next important one. This is an advantage of forward. Okay, I'll explain this. Please listen carefully. This is another a little trickiest one. Okay. Assume your company want to finance, your organization need to finance $1,250. You need to raise finance $1,250. You need to raise finance $1,250. Okay, listen carefully. Listen carefully. You have two ways. Either you can approach bank. Bank means it is over the counter. Or else you can go to the stock exchange, exchange trader. There you can issue debenture. Debenture. Okay. Here, one debenture price, the market price of one debenture is, assume it is 300. So that means if you issue one debenture, you can raise 300. So how many number of debentures should be issued to raise 1,250? The market price of one debenture is already fixed. It is 300. Okay, assume it is 300. How many debentures we should issue in order to raise 1,250? It is equal to how much? 1,250 divided by 300, right? 1,250 divided by 300. What is the answer? 1,000 divided by 250. The answer will be 4.16. We can't issue 4.16. Either we have to settle with 4 or we have to settle with 5. If we settle with 4, listen carefully. If we are settled with 4, how much fund we could raise? 300 into 4, how much? 300 into 4, how much we could raise? 1,200 only. So we are underfinanced, not underhedged, underfinanced. If we issued 5, we will be able to raise how much? 5 into 300, how much we'll be able to raise? 1,500, right? In this situation, it is overfinanced. If you go to the bank, is there any standardized fixed value for the instrument? No. In bank, we will go to the bank, we will make with one contract, we will write the amount. I require 1,250 as a board. It's a tailor-made. Over the counters are tailor-made. You have the flexibility regarding the amount. Whatever amount, you can write it. So how many contracts will be required? Only one contract. Here the numbers we have to be selected. Why? Because here one contract's amount is already predetermined. It is said to be standardized contracts. So exchange trader contracts are, please do listen carefully. Exchange trader contracts are standardized size amount contract, standardized size contract. This will lead to either we will end up with under hedging or we will lead to over hedging. Assume this is not finance, this is an hedging. We need to get protected from a foreign invoice of $1,250. So if the contracts are standardized amount size, if the contracts are standardized size contract, we will be end up with either underheads or overheads. Is it okay? Did you got it? Did you got it? Did you got it? Please do respond yes or no. Yes. But over the counter, see which is standardized contract, amount contract, exchange traded or over the counter? Which is standardized size contract, exchange traded or over the counter? Exchange traded. Over the counter contracts are tailor-made. Okay, now we can write this. Now we can write this. After this, writing this note, we are going to practice questions. One second. Since forward, please do type with me. Since forward are over the counter contracts, it is standardized sized amount contract or tailor-made contract. Do comment. Is it standardized or tailor-made? Tailor-made. So since forward are OTC, it is tailor made or tailor amount contract. Any amount could be hedged with single contract. In a single contract, we can write any amount. So no chance of overheads and underheads. But exchange trader contracts, ETC, but ETC are, could you please come in? Exchange trader contracts are what? Exchange trader contracts are what? Standardized amount contract. Standardized amount contract. There is a chance for we will end up with what hedging? Exact, precise hedging or imprecise hedging? Exact. We have to hedge 1,250. Since it's a standardized amount, there's a chance we might be imprecisely. We might be end up with 1,200 or 1,300 from my example, if I'm not wrong, 1,500. Yeah. So there's a chance for under or overheads, imprecise heads. Okay, having said this, we are going to practice few questions from this area. We are going to practice few questions from this area, theoretical. Mm-hmm. 212. This was a past exam question. Please read carefully and try to find out an answer. I'll wait. Which two of the following derivatives are characterized by standardized contract? Standardized contracts are over the counter or exchange traded contracts. Do comment. Standardized contracts are over the counter or exchange traded. They are ETCs, right? Exchange traded contracts. So we need to pick the exchange traded. Forwards, they are over the counter. So they are tailor made. Future is an exchange traded. So it's an standardized contract. Swaps, they are from which swaps? If you know the mother, from the mother slide, I said swaps are from the bank. So they are also tailor made. So swap is not the answer. We need to pick the standardized contract size. Options can be what? Options can be what? Over the counter and exchange trade, right? Only the exchange traded contracts are standardized. So answer is C and F. Hope you guys are getting more insights this topic. Am I right? Are you feel a bit more comfortable about this theoretical area? Please respond. I want your honest review. Yeah. So wait, I'll show another questions from this area. It's mostly came in our section B type of questions. Okay. Now I'll go for 206. 206. Wait, okay, 206. Only these from our discussion. We didn't discuss about callers. So we can't, at this moment, we are not looking at this. Could you please find out the answer for the third one and fourth one? I will wait. Read and try to identify an answer. The premium on interest options. We have to pay a premium on options. It is payable only when it is exercised. Correct or incorrect? It's incorrect, right? It's incorrect. We have to pay the premium initially itself. We doesn't know what we are going to do in what uh, on the future date, whether we are going to exercise or labs, that doesn't know. But we are getting a flexibility. So today itself, we have to make a payment cost for that premium. Next one. Since the futures are exchange traded, its standardized nature, due to that standardized nature, the over and under hedging can be avoided. See, due to the standardized nature, the under or overheads can be avoided or it will be incurred. What is the correct answer? Due to the standardized nature, this over and under heads will be incurred, right? So this is also incorrect statement. This is also an incorrect statement. Now, we will try to solve a question from this options. One second, options. Yeah, here. See, there are two types of options. There are two types of options. There are two types of options. See, what is an option? What is an option? We have a right, but what not? Right, but not vote. Right, but not an obligation. But not an obligation. We have a right, but not an obligation. Right to what? It could be two rights. Right to buy an item or right to sell an item. At what price? At a predetermined exercise price. This is said to be PE. Options are right to buy or sell, but not an obligation to buy or sell at a predetermined exercise price. In my example, the exercise price was how much? Exercise price was how much? 75. I will compare with the market price. I will compare with the market price. If the market price was 80, what was my answer? I will exercise or lapse. I will lapse. Why? Because we were a buyer. We were a buyer. We have an option to buy. Assume you have an option to sell at 75. You have a right. You have a right to sell at 75. Selling at 75 or selling at market price 80, which is better? Selling at 75 or selling at market price 80, which is better? If you have a right to sell, previously we are planning to buy an apartment. That was my example. I'm changing. You have a right to sell an item at exercise price of 75. Assume the market price was 80. What you are going to do? You will sell at 75 or you will sell at 80. You will sell at 80. So if it was a right to sell, you will exercise it. You don't lapse it. Did I made any mistake? Once again. My mistake. See, if we have an option to buy, if market rate is 80, we will exercise the option, right? We will exercise the option and we will buy at 75. Am I right? We will exercise the option at 75. Since buying at 75 is better, so we'll exercise it. Now, if we have assume we have an option to sell. Assume we have an option to sell. What you will do? You will sell by exercising at 75, or you will lapse this contract and you will go for the market. You will lapse the option contract and you will go for the market, right? So there are two options. Right to buy and right to sell. Right to buy option is said to be call option. Right to buy is said to be call option. And right to sell is said to be what option? If anybody knows, could you please comment? There are two types of option, call option and put option. Okay. Fine. Based on this, we are going to solve one example. Right now, we will focus only on this. A call option on 500,000 euros at an exercise price of, for every euro, we have to buy it $1.9. So this means that if we exercise, we have, see, it's a call option. Call option means buy or sell. Could you please respond? Call option means buy or sell. Call option means buy or sell. So we have to buy at this price only if we exercise or lapse. We have to buy at exercise price only if exercise or lapse. See, we have to buy the item through option contract at exercise price only if exercise or lapse. Only if exercise, right? If we lapse, that means we are not buying at exercise price, we'll go for the market. Assume on the expiry date, the market rate is 1.95 for each pound. For each pound, you have a two option. Either you can exercise at exercise price, you can buy at 1.9, or you can buy from the market at 1.95, which is better option since it's an buy option. Buy at a smaller rate of 1.9 or buy at higher rate of 1.95, which is better. Buy it 1.95. In order to buy it 1.95, you have to exercise the option contract or you have to lapse the option contract. In order to buy at exercise price, you need to exercise the option contract or you need to lapse the contract. You need to exercise the contract. So answer is call option. See, for buyer, we will look at for the lower price. For a seller, we will look at what price? For a seller, we will look at what price? Try to reduce it or try to increase it. Try to increase it. So exercise price is lower than for the buyer, so they will exercise. Similarly, could you please try for put option and identify whether it is going to exercise or lapse the option? I will wait. I'll wait. You have a right to what? Put option means you have a right to vote, buy or sell. You have a right to sell at this rate. You have a right to sell at this rate if you exercise the contract. Or else you can lapse it and go to the market and you can sell it at 2.95, which is better. Selling in the market or exercise the contract. Selling in the market, right? So in order to sell in the market, you should, selling in the market is better. You are getting more money. You are getting more money. So you will do what about the contract? This option, you will let it lapse. Array, is it more clarity regarding these options? Please do respond. I need a honest review. Yeah. Good. Now, we will go to a few other questions regarding from this. 190. This is not a past exam question. Okay, 195 is not a past exam question, but since a simple question, we'll just. Which of the following statement is true of about option? Options are not an obligation, not an obligation. So B and D could be easily removed. Out of A and C, which is the right one? A or B? It's a put option. It's a put option. It's a put option. Option A is a right to sell. Okay. Now, see, there is another risk named as interest risk. Quickly, we will consider interest risk. I'm only looking at forex risk. Okay, we started with the forex risk and we are going to interest risk as well. Forex risk, and we are also facing interest risk. See, forex risk is due to change in which rate? Forex risk is due to change in which rate? Interest rate or forex rate? Interest rate or forex rate? Forex rate, right? Similarly, the future interest rate is also uncertain. The future interest rate is also uncertain. The interest rate might increase or decrease. So the interest payment or receipt is uncertain. That is said to be interest risk. In order to get protected from the interest risk, similar to forex risk, we could enter in a forward contract. We could enter into a forward contract. Here also we could enter into a forward contract. This forward contract is said to be forward exchange contract. Since it's a foreign exchange, since it's a contract on foreign exchange, it is said to be forward exchange contract. Interest risk forward, since these are on interest rate, this is said to be forward rate agreement. Both are same only. In terminology, it is different. Forward rate agreement. If you enter on this forward, that means whether it is a forex rate or interest rate, this is going to be moved. If you enter into a forward exchange contract, or if you are entering into a forward rate agreement, the expected interest rate or future rate is going to be what? Is going to be what? Locked. And both of these are, we will be entering from bank, they are over the counter. Is it okay? Is it okay? Yeah. Next, futures. These are said to be currency futures. Currency future. Here it is said to be interest future. This also makes us the final result again fixed. Futures also makes final result fixed. These are exchange traded. Now there are forex option. Forex option. Similarly, there is interest options. Interest options. These could also be from over the counter and as well from what? Exchange trader. Okay, exchange trader. And another one, interest swap. Then, sorry, interest swap will be here. Here it will be forex swap. These are from over the counter. Okay. These are the external hedging methods we will be follow for interest risk. Now, if you enter into a forward rate agreement, if you enter into a forward rate agreement, if you enter into a forward rate agreement, listen carefully. We are about to discuss the final points from this external hedging. If you enter into a forward rate, this is in short form, it is said to be FRA. FRA. If you are entering into a forward rate agreement, assume your FRA, you took the FRA 5%, and you are a borrower. There could be two situations. In case of interest, it could be two situations: borrower or depositor. Borrower or depositor. Borrower or depositor. If you are, assume you are a borrower and you took an FRA of 5%, whatever market interest payment, market interest rate, the interest rate could be 7%, interest rate could be 8%, interest rate could be 9%. Whatever the rate, your final interest payment will be how much? Since it's a lock-in rate, your final interest payment will be what? Your final interest payment will be locked at 5%. Whatever the market interest rate, your final interest payment will be locked at FRA. Locked at FRA. See, for a borrower, the market interest rate is increasing. For a borrower, the market interest rate is increasing. Is it an adverse movement or favorable movement? For a borrower, he has to pay interest. If the interest rate is increasing, is it an adverse or favorable? It's an adverse. Since we took forward, we will get protected from that. We will get protected from that, right? We are getting protected from adverse movement. What if the rate decreases to 4% or 3% or 2%. This is an adverse movement in the market or a favorable movement in the market for a borrower. This is a favorable movement in the market, right? But since we are entered in the lock-in rate, we will end up with paying with the 5. So we will lose the opportunity to take the market favorable movement. This was we already learned for Forex futures. Sorry, Forex forward. Will be similarly applicable to the interest forward also. Is it okay? Is it okay? Is it okay? Yeah. Now, if at all we took an options on FRA. Options on FRA. For this, we have to pay a premium, right? Assume the rate guaranteed was 5%. Assume the rate guaranteed what 5%. Assume these are the market interest rate. Assume these are market interest rate. See, you are guaranteed at 5%. Is this adverse movement or favorable movement in the market? Adverse movement in the market or favorable movement in the market for a borrower. Assume you are a borrower. You are a borrower. You assume you are a borrower. It's an adverse movement. So you will exercise the contract, exercise option. You will exercise the option. I will write E. E stands for exercise. Okay. All of these cases, I will exercise the contract. So my final interest payment will be how much percentage? We are guaranteed a 5%, right? So final interest payment will be 5%. What if the market rate reduced? Is it a favorable movement or adverse movement? That for a borrower, interest rate is reducing. It's a favorable movement. Do we have an obligation to always to take the contract at 5%? Do we have an obligation? No, right? So what we will do, if the in market it's a favorable movement, what we will do, we will lapse the contract, right? We will lapse the contract. So we will only end up pay, our final interest payment will be that the same 4% of interest rate reduced, we will end up with 3%. We will end up with 2%. So we are getting protected from the adverse movement. We are getting protected from the adverse movement. But without losing the benefit of taking favorable movement in the market, since we are entered in option contract. Is it okay? Is it okay? Okay. So if you took an option, you are certain that your interest payment will not be more than what? Whatever the market rate, if market rate increases to 10, 11, 12, 13, 14, whatever rate, you are guaranteed that your maximum payment of interest will be how much? Your maximum payment of interest will be how much? 5%. It won't go above than 5%. So this options on FRA is named as interest rate guarantee. Interest rate guarantee, which could also be named as in exchange traded terminology, it is named as cap. Cap means maximum limit. Right? Cap is mean by maximum. For a borrower, increase in interest rate, it has to be capped, right? It has to be limited. So we are putting a cap of how much percentage? We are putting a cap of how much percentage? In this example, 5%. So the interest rate won't go more than 5%. If for a borrower, it was capped. For a depositor, it is not capped. He want to get protected from, for a depositor, he want to get protected from rise in interest or decrease in interest? Decrease in interest, right? So If options on FRA is 5%, that means the depositor is guaranteed that interest rate won't go below 5%, won't go below 5%. It is said to be floor. So there are two options. There are two options: cap and floor. Which person require cap, borrower or depositor? Which person require cap, borrower or depositor? Could you please comment quickly? Which person require cap, borrower or depositor? Borrower. Borrower. Right? Borrower. Depositor require what? Depositor require. He want to get protected from the decrease in the interest rate. So he'll go for what? Floor. Right? Floor. Okay. If we took for FRA, if we took FRA, that means we are locked. We are locked. If you took FRA, we are locked. But if we took FRA, we are locked at 5. If we took cap, that means interest rate won't go more than 5%. If we took floor, that means interest rate won't go below than that. Hope you understood. Cap, floor. Who wants which? Borrower requires cap, deposit requires floor. Is it okay? Could you please comment? Yes or no? Yeah. Based on this, we will practice a question. 196. Please go for it. True or false? Please go for it. True or false? I'll wait. See, we need to say true or false. The aim of FRA is to get locked into a target interest rate, which will get protected from adverse, and we will lose the opportunity to take the favorable moment. It's a true statement. It's a true statement. So A has to be true. Instead of FRA, if we went for interest rate guarantee, see, interest rate guarantees are other names for what? Options, right? Interest rate guarantees are other name for option. They are expensive than FRA, since we have to make a payment for the flexibility we are getting in order to, we are able to take the advantage of the favorable market rate movement. What is the payment named? What is that payment named for options? What's that payment named? It's premium, right? It's premium. So options are more costlier than forward or futures. We can say, see, one more item is locked. Not only forward are locked. This is over the counter lock-in rate. We will get the lock-in rate from exchange rate also. Which is exchange rate or lock-in rate? Which is exchange rate or lock-in rate? Could you please comment? Which is exchange rate or lock-in rate? Futures. Compared to these two, options are costlier. Compared to these two, options are costlier. So both statements are true. Option A. Is it okay? Did you got the concept of this? See, here interest rate hedge, both adverse and favorable, means we will lose the opportunity to take favorable and we will get protection from the adverse. We are neutral. We can't go for adverse and we are not able to take the favorable. That means hedge. It makes certainty. Is it okay? One student asked the doubt. That's why. And I've missed his name. Asna. Yeah. Now, there is one more contract named caller. One more contract named caller. It's not a different contract. It's not a different contract. See, the objective of caller for your limited requirement at FM level. AFM level, I'll be teaching you more points regarding these callers. At this point, for FM level, you need to learn only this objective. Objective of caller to reduce premium cost. To reduce premium cost. Borrower, for a borrower, which option they require? Cap or floor? Tell me. Borrower require cap or floor? They require cap. Okay. So borrower buys cap. For this, they have to pay what? In order to take the cap, they have to pay what? They have to pay, since it's an option. Since it's an option, they have to pay what? Premium. Similarly, for a depositor, for a depositor, which they will buy? They will buy what? Could you please comment? They will buy what? They will buy floor. They will buy floor. So they have to, whether you buy a cap or floor, since you are buying the option, you have to pay premium. Whether you are borrower or depositor, you are buying whatever is suitable for you. For a borrower, the suitable option is cap. Since you are buying it, you have to pay premium. Similarly, for a depositor, the suitable option is to buy floor, so that you have to make payment. This is said to be straight options. This is said to be straight options. Instead of this, in a caller, in case of caller, I'm going to explain caller. Okay, this was about straight options. This was about straight option. Now I'm going to explain caller. See, you need to learn this only. What is the objective of caller? What was the objective of caller? Objective of the caller is to reduce premium cost. Objective is to reduce premium cost. In caller, how they will reduce that? See, a borrower buy a cap. That means we are taking an option from a counterparty. We are taking an option from a counterparty. Simultaneously, and not only do this, and sells the other option. Sells other option. While you selling the option, you will receive premium. Previously you were just buying an option. You were just that buying party. The other party is actually selling the option. Who will receive premium? Who will receive premium? The buying party or selling party? Which party will receive premium? Whichever counterparty selling the contract in the market will receive premium, right? Previously we were just in a straight option. We were borrower. He require a cap, so he'll take the cap. From who he is taking the that cap? He's taking from another counterparty. So we are making a premium payment to the other party. That means other party is receiving a premium payment. So in case of caller, simultaneously we will buy an option and we will sell another option. For the both option, we will receive premium. Sorry, for the both option, we have to pay premium. For the sold option, we will receive premium. Altogether, we are paying premium and receiving some premium. Altogether, the premium cost will be increased or decreased. Altogether, the premium cost will be increased or decreased. See, this is the only point you have to learn at this limited level of FM. Previously, you are just paying premium. Now you are paying some premium and you are receiving some premium. So overall premium cost will be what? Reduced. Overall premium cost will be reduced. But the problem is, previously you were guaranteed at 6%. The interest rate won't be more than 6. But if the interest rate reduces, please listen carefully. Last point. This is the last point we are going to learn. Okay, listen carefully. See, if you bought a cap at 6%, if you bought a cap at 6%, that means what? That means what? That means what? The interest rate won't go more than what? The interest rate won't go more than 6. Simultaneously, you are giving a guarantee to another party. You are giving to a guarantee, a floor to other party. Floor will be lower than this. See here, in my example, previously in my example, if interest rate reduces, you have the opportunity to get the entire reduction. Here, in collar, the answer will be in between 6 and 4. See, previously, in a straight option, if it's a 6%, this means your interest rate won't be more than 6. Your interest rate won't be more than this 6. If interest rate reduces, your answer will be the reduced one. But since in collar, simultaneously you buy an option and you sell an option, your interest rate won't go more than 6. It could be reduced, but maximum it will be reduced till which point? It will be maximum reduced till which point? 4%. So we are losing some flexibility. Previously, the interest rate can be 3, 2, 1. It can be reduced any point. We were getting full flexibility. In collar, we will lose some flexibility. But we can reduce what? We can reduce the premium cost. So only thing you have to learn from collars is collar is expensive than forward and future. Collar is expensive than forward and future, but collar is cheaper than straight options. Are you agreeing with that? Forward, future, they are lock-in rate. They don't have any premium payment. Straight option, they are having premium payment. Collars also having premium payment, but comparatively lesser premium payment. Collars are cheaper than what? Could you please say? If you just take a cap, it's a straight option. If you just took a cap, it's a straight option. Instead of cap, you can take collar. Instead of a cap, the collar will be cheaper. Even instead of a floor, the collar will be cheaper. Collar means simultaneously buying and selling options. For depositor, he will buy a floor. Simultaneously, he sells what? He bought a floor. Simultaneously, he sells what? In a collar. He sells cap. So, his interest rate, assume floor is 3%. It means he is guaranteed that his interest rate won't reduce than 3. If increases, it's a benefit, but maximum it will increase to 7%. So assume this is the rate, their answer will be somewhere in between 3 and 7. 3 or 7. In between 3 to 7. Okay. If you take a straight option, compared to straight option, collars are cheaper or costlier. Compared to straight options, collars are cheaper or costlier. Could you please comment? Cheaper. This is the only thing you need to learn at this FM level. There's one question from this area. This is the final question we are going to discuss today, and I'll take one or two few doubts of yours. See, first one. Think and read and try to find the answer. It's about floor. Floor means just only one. It's not collar. Just floor means either just floor or just cap. It is not collar. It is straight options. Interest rate floor can be used hedge for what? They said increase in interest rate. In order to hedge increases in interest rate, can we use floor or cap? It has to be what? Cap, right? Floor will use to hedge from the decrease in interest rate. So the statement is true or false? I mean, correct or incorrect? It's incorrect, right? It's incorrect. Are you getting clarity? Could you please confirm? I want your response. Yes? Yes? Excellent. Excellent. Now try this. The cost of an interest rate floor, just a floor only. That means, is it a collar or straight option? Just a floor only. Is it a straight option or not? It's a straight option. The cost of a straight option is higher than the cost of a collar. Straight option is costlier than collar. Correct or incorrect? It's correct. Done. We are good. We are good at this point. My battery is low. Let me connect the charger. 1 second. The final thing, swap. Swap means interchange. We are entering with a counterparty to interchange the interest or forex converted money. Only thing you have to learn, the commonly tested thing from swap. I'm not guaranteeing this, but mostly tested about swap is mostly tested thing about swap is swap compared to any other contracts, compared to any other contracts. Swap can be used for long-term hedging. All other are short-term hedging. Swaps are having long-term hedging, like 5-year, 6-year, 7-year hedging you can use. What is forex swap? What is interest swap? That is other thing that requires much more time to explain. Since the time is over, it's around 10 p.m. now. I'm going to stop today's session. How it went? How it went? Did you like the way I explained the content? So try to solve few more questions from this theoretical area. Section B questions are there regarding this. For example, I'll show you a few questions to practice. Section B. I'll take a few more questions. We got 5 more minutes. Since you are happy with my session, since you said it's excellent, I'm so excited to share some. Sir, yeah. Meenakshi said, sir, really helpful, very much. Confusions are there, but now it is very clear. Okay. Let's see more. See, don't just learn this. You have to practice more. Then you will get more clarity. Section B, it's in 99. 99 means around 130 it will be. Yeah. I'll take the latest questions. Latest questions are marigold is the latest one. Could you please take page number 139? In my exam, it is 139. I don't know your version. You might be having latest one or the older one. Do you have this question with you? It's a marigold question. Could you please confirm? It's in my exam, it's 130. Definitely, it's in somewhere near in 139. You have this question in marigold. Marigold. Yeah. Could you please solve question D? Question D. At least try to see. You won't be able to get everything, but you'll be able to solve at least 2 to 3 options, a minimum. Try to do that. I'll wait. At least you can say A is right or B is wrong. At least A, B, from the ABCD, at least 1 or 2 definitely you can easily say right or wrong from this session. Consider that. You guys going through the question. See, marigold is now considering an option. They are considering an option to hedge their currency risk. Their bank offered an over-the-counter option, so they are going to take from the over-the-counter. First statement: options will be more expensive to set compared with either forward contract or money market hedge. That's a true statement, right? That's a true statement, right? Yeah. Now, next one, an imperfect hedge, that means under hedge or over hedge, will result as the option will be a standard amount of currency. Only whole number. We can't go for 4.17. We have to settle with 5 or 6. This was 4 or 5. This was what we discussed at the time of standardized discussion. Tell me, is this option has been taken from exchange rate or over the counter? You have to carefully read this. This is from where? Over the counter. Over the counters are standardized amount contract or tailor-made contracts. tailor-made contracts. So this is a wrong statement. It's a perfect hedge we are going to get. It's a tailor-made. This requires more explanation. We doesn't know what is this. We can keep it like I don't know this. Okay, wait. Go to the D one. If D is wrong, this has to be right. If D is right, this has to be wrong. In exam questions, there will be one statement requires more explanation, more time. If you felt it is a little confusing, that try this elimination technique. Like other three will be easy then. Okay. Using an option, that means Marigold is obligated to exercise? No. So option D is what? Option D is what? Option D is false. So the C has to be right. So answer is A and C. How many of you had that A and C? Let me know yes or no. Your answer was A and C. Are you this? Tell me very, very honestly. Is this because of attending the session you made the right answer? You got the right answer after attending this session? Then I'm very proud about that. Our 2 hours went effective. Yes, great. Yes, super. This is a past exam question. This is asked in 2021, I guess, Marigold. Similarly, can you solve question E also? This is also theoretical. This is the last question. Okay, this is the last question we are going to discuss today. It's already 10 now. Try this. I'll wait. At least 2, 3. Definitely, you might be struggling in this area. Why? Because, see, this is comparing with forward to what? Forward to what? Money market. Today, did we discuss about money market heads? It is an money market heads we didn't consider. It requires a much more time to explain money market heads. Money market heads can be a numerical question also. We didn't discuss about money market heads. I'll give you one hint. That flexibility to take advantage, the flexibility to take advantage of favorable movement, that only will happen in which contract? Forward, future, options, MMS, swaps. It's only available in what? Options. Okay. Options. Fine. Now, forward contract has the advantage of being tailor-made. But money market is a standardized. See, forward contract is an over the counter. What about money market? What about money market? That I already explained to you. Money market is also over the counter. So both are tailor-made. Both are tailor-made. So option is A is wrong. Option A is wrong. Option C. I'll go to option C. The forward contract will result in a being fixed. But money market hedge will allow us to benefit from favorable movement. Wrong. Only one contract will be we will be having the benefit from taking favorable movement. Which one it is? It's not MMH. It is what? It is what? It's not money market hedge. It is what? We'll be having that benefit of favorable movement only options, right? So that's also wrong. Similarly, Marigold will be obligated to fulfill the forward contract, but money market are traded in exchange. Isn't it exchange traded derivative contract? Money market, is it an exchange traded contract? No. So this is also wrong. Right answer is B. This is a receipt question from the scenario. It was a receipt question. Marigold is expecting a receipt. So they are expecting some money from foreign to home. They are expecting some money from foreign to home. In order to convert this today in money market, we will borrow money from foreign and will convert this foreign currency in this question was MS. So MS will be convert. We will receive MS today itself, and it will be we will borrow in MS, and we'll convert it to dollar if dollar is our home currency, if I'm not wrong. And we'll deposit this. This is what happening in MMH. This is a very base for MMH. I'm not explaining MMH since we are running out of time. That was the concern. But tell me, guys, anyhow, are you comfortable till this point? Is it our 2 hour? Yes? Yeah, yeah. So having said this, I'm going to stop today's session. Thanks for joining. I'm, as a tutor, as a teacher, I'm very happy that my efforts are always valuable for my students. So thank you, everyone. Thanks for joining. Have a tight sleep. Yeah, that's it.